Hey there, money mavens, are you ready to demystify another Wall Street head-scratcher? Today's puzzle, EBITDA. Sounds intimidating, right? Like something only guys in pinstripe suits whisper about. But hold your horses. EBITDA is simpler than you think, and it's a powerful tool for any investor. We're talking about understanding a company's core profitability. No smoke, no mirrors, just pure earning power. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Yeah, it's a mouthful, but stick with me. We'll break it down piece by piece so you can impress your friends at cocktail parties. Get ready to sound like a financial whiz. Okay, so maybe you're not managing a hedge fund, but understanding EBITDA can still boost your investment game. Why? Because it gives you a clear picture of a company's operating performance. Think of it like this. You're checking out a used car. You want to know how well the engine runs, right? EBITDA is like lifting the hood and getting a good look at the engine of a business. It strips away all the financial noise, the interest payments, the tax bills, even the wear and tear on equipment. What's left? A pure measure of how much cash the company is generating from its core operations. That's the good stuff. Alright, enough with the car analogies, let's get down to brass tacks. The EBITDA formula. Don't worry, it's not rocket science. Here's the magic equation. See, not so scary, right? We're basically taking the net income, what the company made after expenses, and adding back those non-operating expenses like interest and taxes. And don't forget depreciation and amortization, which reflect the gradual decrease in value of assets over time. EBITDA in action, a lemonade stand story. So, let's say you're a young entrepreneur with a booming lemonade stand. Go you! You've got the entrepreneurial spirit and a great product that people love. You sell a refreshing glass for $1, and you sell 100 glasses a day. That's a lot of lemonade and a lot of happy customers. Revenue, 100 glasses times $1 per glass equals $100. This is your total income from sales before any expenses. Expenses, lemons, sugar, cups, etc. Total $20. These are the costs you incur to make and sell your lemonade. Net income, $100 minus $20 equals $80. But wait, this is not the whole story. You also borrowed $100 from your parents at a 10% interest rate to buy that fancy new lemonade squeezer. This loan helps you make more lemonade efficiently. And let's say the squeezer depreciates by $5 over the year. Depreciation is the reduction in value of your equipment over time. Interest, $100 times 10% equals $10. Depreciation, $5. These are additional costs you need to consider. Now for the EBITDA magic. Remember, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. EBITDA, $80, net income plus $10, interest plus $5, depreciation equals $95. See? This gives you a clearer picture of your business's profitability. Your lemonade stand is a cash-generating machine. By understanding EBITDA, you can better manage your finances and make smarter business decisions. The good and the bad. EBITDA is a powerful tool, but like any tool, it has its limitations. Let's break it down. The good, easy to understand. It cuts through the clutter and gives you a clear picture of profitability. By focusing on earnings before interest, taxes, depreciation, and amortization, it simplifies the financial landscape, making it easier for investors and analysts to grasp the core earnings of a company. Great for comparisons. You can use it to compare companies in the same industry, even if they have different capital structures. This is particularly useful when evaluating companies with varying levels of debt or different tax situations, as it levels the playing field and provides a more apples-to-apples comparison. Highlights cash flow. It gives you a sense of how much cash a company is generating, which is crucial for growth and debt repayment. Understanding cash flow is essential for assessing a company's ability to invest in new projects, pay dividends, and meet its financial obligations. Now the bad doesn't tell the whole story. It ignores important factors like capital expenditures, those big investments in equipment and infrastructure. These expenditures can significantly impact a company's long-term financial health and operational capacity, and ignoring them can paint an incomplete picture. Can be manipulated. Companies can sometimes use accounting tricks to make their EBITDA look better than it is. This manipulation can involve adjusting revenue recognition or delaying expenses, which can mislead investors and stakeholders about the true financial performance of the company, not a substitute for cash flow. While it gives you a sense of cash flow, it's not a replacement for actual cash flow statements. Cash flow statements provide a more comprehensive view of a company's financial health, including operating, investing, and financing activities, which are crucial for making informed investment decisions. EBITDA for stock superstars, or those who want to be. Now, how can you use EBITDA to pick winning stocks? This is a key metric that investors use to evaluate a company's financial performance. It helps you understand the core profitability of a business by stripping out non-operational expenses. Here are a few tricks of the trade. First, always compare apples to apples. As I said earlier, use EBITDA to compare companies in the same industry. This ensures you're making a fair comparison, as different industries have different financial structures and cost bases. A high EBITDA margin. EBITDA divided by revenue usually indicates a more profitable and efficient company. This margin helps you understand how much of a company's revenue is converted into EBITDA, giving you insight into its operational efficiency. Look for growth. Ideally, you want to see a company's EBITDA growing over time. Consistent growth in EBITDA is a strong indicator that the company is expanding its operations and increasing its profitability. That's a sign of a healthy and expanding business. A company that can grow its EBITDA over multiple quarters or years is likely managing its resources well and capturing more market share. Don't ignore debt. EBITDA doesn't factor in debt, so make sure to look at a company's debt levels before getting too excited about its EBITDA. High debt levels can be a red flag, as they may indicate potential financial instability. Remember, EBITDA is just one piece of the puzzle. While it's a useful metric, it doesn't tell the whole story. You need to consider other factors like management quality, industry trends, and overall market conditions before making any investment decisions. A holistic approach will give you a more accurate picture of a company's true potential and help you make more informed investment choices. So there you have it, folks. EBITDA. Demystified and ready to be added to your investment arsenal. It's a simple but powerful tool that can help you understand a company's true earning power and make smarter investment decisions. Now go forth and conquer the markets, my fellow investors, and remember, knowledge is power and profits.